And as time goes by, I believe the tariffs paid for by foreign countries will, like in the past, substantially replace the modern-day system of income tax, taking a great financial burden off the people that I love.
Hello and welcome to the Week Ahead on Nomura Podcasts. My name is Zubin Paracuelis, Chief Southeast Asia Economist at Nomura in Singapore, and today is Friday, the 27th of February. Tariff policy uncertainty came back after the U.S. Supreme Court struck down the IEEPA tariffs, but President Trump quickly announced implementing a global 10% tariff under Section 122 of the Trade Act and posted later in social media a further increase to 15%. This brought confusion as to where effective tariffs could now end up and what happens to bilateral trade deals already made. As you heard in the clip, President Trump in his State of the Union address insisted on the benefits of the tariffs, including how he sees the revenues potentially replacing income taxes in the U.S. over time. Meanwhile, market concerns relating to Iran and talks with the U.S. are lingering, and oil prices have been facing some upward pressure as a result. To discuss the implications, I have my ever-brilliant colleagues joining me in this episode. David Seif, our Chief Economist for Developed Markets, George Buckley, our Chief Economist for the UK and Europe, and Jing Wang from our China economics team in Hong Kong. We will also preview the upcoming US jobs report, the spring statement in the UK, the annual NPC meeting in China, the central bank decision in Malaysia, and a slew of inflation data releases in the rest of Asia. Finally, in a special segment, I invited Tomochika Kitaoka, our Chief Equity Strategist in Japan, who will explain why he remains positive on the stock market there, despite the strong rally after the lower house election, the sectors that could outperform, and the risks to watch both upside and downside. You don't want to miss that. So let's get going. Okay, let's kick off with the U.S. And hey, David, great to have you back in the podcast. Thanks again.
My pleasure. Always great to be here.
So let's start with the week ahead. There's the all-important jobs report. What do you expect there?
Yeah, jobs report does tend to be the most important data release of the month in the U.S. And look, we're certainly not expecting anything that is quite as blockbuster as last month's report, which came out a couple of weeks ago. So I will just say as a small caveat that as of the time of this recording, we have not finalized our forecast, although it will be out by the time this podcast actually is released. But I think what's clear to us is that, one, we see the unemployment rate remaining steady at 4.3%. There's really just nothing to indicate that it will move down or move up. One, and two, we certainly see a positive for NFP, but it's very unrealistic to think that we're going to get anything like the 130K NFP that we got for January, and perhaps more importantly, the real blowout 172K for private payrolls. We think that what we saw last month was a combination of a cyclical reacceleration that we very much think is going on, but also some payback for some lousy data, both in terms of actually it was fundamentally bad, but also low data quality that had happened partly as a result of the government shutdown. So we would expect clear, solid job growth for the month, but nothing that is as good as what we saw in January.
Okay, got it. And I guess this is the theme in this podcast, and every guest here in this episode, I've asked this question on the implications of the Supreme Court ruling on the tariffs and Trump's response as well under Section 122. So what do you see as the impact of the tariffs overall?
Yeah, well, one theme we've really pushed, and we pushed prior to this decision when we expected, as was the case for Trump to lose, is that this really is less important from a macroeconomic perspective than it has been from a perhaps political position. We identified 6 powers that Trump had to institute tariffs. And just one of those, the IEEPA power, was struck down or largely struck down by the Supreme Court. But that still leaves 5 additional powers. And so this is a matter, we think, of Trump perhaps losing the battle here, but still very likely to win the war. What he did, exactly as we expected, he immediately moved to impose Section 122 tariffs. These are tariffs that can go up to 15%. So far, they're only in place for 10%, but Trump has alluded to them going higher. And these can last for up to 150 days, which would take us to the 24th of July. At that point, they have to go away. But in the interim, what we expect is for Trump to start doing so-called Section 301 investigations. This is yet another power that he has. And this is something that is tried and true because he did it in his first term against China, survived Supreme Court scrutiny. He could do this, and we expect he will do this at a much broader scale, targeting a number of countries. EU probably counts as a single country under this because it's one trade bloc. So with not that many Section 301 investigations, he is likely to be able to replicate either the vast majority or perhaps even 100% of the tariffs that the Supreme Court struck down. So we have for the next several months Section 122 acting as a bridge. Yes, there are some relative winners because the nuances of the IEEPA tariffs have not been preserved. So countries that had higher tariff rates, India, China, Brazil, for the time being, they are net winners from this. But again, even that sort of semi-relief for those countries, we expect to be temporary and really just months, not an indefinite sort of thing.
Okay, yeah, that's very clear. So in the end, maybe effective tariffs will be no different from where we were before the Supreme Court ruling.
We certainly think by the end of the year, Trump is able to impose pretty much whatever he wants, just using different authorities. If we end up having fewer tariffs in place at that time, it will probably be not because Trump had to do it, but because Trump chose to do it.
Yep, got it. And finally, David, so of course, there's a lot of focus as well on the issue with Iran. And I know you just did a webinar, a macro brew with an expert. Maybe you could just walk us through any key takeaways from that discussion.
Yeah, so we were delighted to be able to hold a macro brew on Thursday. And that is available in replay form for clients of Nomura. The key takeaways were pretty sobering, with an expectation from our outside expert that conflict is certainly quite a bit more likely than not, that Iran is stalling for time, but really Iran has certain red lines, the U.S. has certain red lines, and that those are incompatible. Now, perhaps with that sobering starting point, the thought was that this was likely to be a more limited conflict, one that would have relatively little disruption to oil infrastructure, unlikely that Iran has either the capacity or the desire to close the Strait of Hormuz, which would possibly lead to a much wider war, and a situation resulting where the Islamic Republic is still in power, but perhaps more moderate forces have crept in and are able to lead it in a somewhat different direction from where it has been going. But to be clear, not one where the Islamic Republic falls altogether and there's regime change.
Okay, that's great. Let's leave it at that. David, excellent as always. Thanks very much.
Great to be here.
Okay, let's swing over to London, and I'm joined by George Buckley. Hey, George, good to have you back on, and thanks for coming.
Yeah, thanks for having me.
So I guess it's a relatively quiet calendar for the week ahead in your region, but there is the spring statement in the UK on Tuesday. Anything that you want to flag there, and what do you expect?
Yes, well, there's always something to talk about on the UK, isn't there? And the spring statement is it for next week. Now, it is a statement. It's not a fiscal policy event as such. It's only an analysis of where we are, how we've changed over the last 3 months. How much can change over the last 3 months? Well, it turns out a lot, because the latest public finance data have been very positive indeed for the Chancellor. And what that means is that we're probably going to see a little bit less gilt issuance, maybe just under 250 billion, which is down by about 50 billion relative to the previous fiscal year. So this is talking about 2026-27, and that'll be important for the markets. How much one individual number, and this was the January public finance prints, which were a lot better than expected, how much one of those public finance numbers can influence the fiscal rules, which are judged 4 years out, is questionable. And I think that's going to be a lot more dependent on how the Office for Budget Responsibility changes its forecast for economic growth. There hasn't really been that much news over the last 3 months, so I don't really see the need for drastic changes there. But we will be evaluating how the fiscal rules are going, and how and whether the Chancellor is likely to meet them in 4 years' time.
Okay, got it. But sounds like there's something to watch out for from the bond market's perspective, at least in the near term. And I guess shifting gears a little bit, and I've asked all the guests in this episode in terms of the implications of this Supreme Court ruling in the U.S. And Trump's response for a global tariff now. What do you think is the implication for the UK and Europe? And also, especially in this context of trade deals that have already passed, and there seems to be quite a bit of confusion now on the back of this Supreme Court ruling.
Well, as you haven't told me what the others have said on this, I do hope we're all singing from the same hymn sheet here, but I suspect we are. The tariffs that have been announced, the new tariffs, at least for the UK, are not drastically different to what we had in place before. So 10%, maybe it could go to 15. That's what's being discussed, but I don't think they're drastically different. It does inject just another period of uncertainty into the equation. And of course, there have been a number of surveys and studies done in the past which have said that actually it's not the tariffs themselves that create the weakness in economies, but largely the uncertainty behind that. So I think that could be an important part of the story, but I don't see it being a big deal. Also, these tariffs are only going to be in place potentially for 150 days. There might be other ones to replace those from other sections, from other acts, but I suspect that the impact is going to be relatively limited. One more thing just to mention is that it does seem that developed economies, the UK, the euro area, have fared a lot better when it comes to the tariffs which have been implemented so far. Big debate in the accounts of the European Central Bank meeting, the last accounts they published for the meeting of December, where they had an active discussion about whether this was just a delay in the impact of tariffs or whether economies have generally been more resilient. And I think there's a lot of evidence to suggest that it could be the latter.
Okay, got it. Yeah, and I guess for the rest of the world, it's the same message. It doesn't really warrant any big changes to our views at this point. Just watching how this all plays out. It's still fairly uncertain. And then, of course, we've got the U.S. midterm elections, and, that could complicate in terms of the timing as well. Yeah, fantastic. We'll leave it here, George, and thanks very much.
Thank you, Ewan.
Now let's go to China and the rest of Asia, and I'm very delighted to be joined by Jing in Hong Kong. Thanks, Jing, for joining, and welcome back to the podcast.
Yeah, thanks, Ewan. It's great to be back, and happy Chinese New Year.
Yeah, same to you. Just firstly, it would be interesting to exchange notes a little bit in terms of the impact of this Supreme Court ruling in the U.S. On the tariffs, and then Trump's response of the Section 122 tariffs, which brought it up to around 15%. China, in our report, looks like it's going to be one of the biggest beneficiaries across the region in terms of lowering the effective tariffs. Does that have an impact on your economic outlook?
Yeah, so according to our estimates, the effective tariff rate on China will drop by 6 percentage points to about 28%. So this lower tariff rate is supposed to benefit China's exports. But we don't think this slightly lower tariff would be material enough, to change our outlook on exports. In fact, if you remember, at the end of October last year, the U.S. rolled back the 10% fentanyl tariff as part of the agreement, reached in KL between two countries. But the China's exports growth to the U.S. still worsened in November and December to minus 30% year on year, from minus 25% in October. And so it's unclear, right, whether this lower tariff will have a big impact on China exports. In addition, according to our U.S. team, the Trump administration should be able to use other legal instruments to impose new tariff and replace the overturned IEEPA tariff, although it may take some time to go through the process. Yeah, so overall, we still maintain our export growth forecast of 4% for this year.
Okay, got it. And yeah, I would say it's the same for the rest of Asia. It doesn't really warrant at this stage any changes to our forecasts. So outside of China, ASEAN countries and then India will have lower effective tariffs as well. But then countries like Singapore, which had a 10% reciprocal tariff, could see their effective tariffs pick up a little bit. But then by our estimates, it's still going to be the lowest in the region. So again, doesn't really warrant any changes in the view. But I would say medium-term trade policy uncertainty has picked up. As you say, there's still a threat of future tariffs under Section 232 and Section 301. So that remains to be seen. We have the midterm elections as well in the U.S., so the timing could be complicated by that as well. In terms of the week ahead, Jing, for China, we have the annual NPC meeting on Thursday. What do you expect there?
Yeah, so at this NPC meeting, Premier Li Qiang will deliver the government work report, which will include the growth target and the fiscal budget. For the growth target, it was the same over the past 3 years at around 5%. But for this year, we think it's very likely will be slightly lower to a range of 4.5 to 5%. Actual local governments have already announced a target and lowered the target, so we think a central government will do the same for the whole country. For the fiscal budget, the official and narrow fiscal deficit ratio will likely remain unchanged from last year, when it was raised to a historical high of 4% of GDP. And because the Ministry of Finance already pledged to ensure more fiscal spending for this year, and because the fiscal revenue is very likely to remain sluggish on this deflationary pressure, so we think the government bond issuance quota will likely be raised accordingly to endorse Beijing's more proactive fiscal policy stance.
Okay. Yeah, interesting. And what about the data? What are you watching for next week? I guess there's some PMI numbers.
Yeah, the PMI data is due next Wednesday. We expect official manufacturing PMI to remain subdued and unchanged from January at 49.3. But I just want to say, because of the data connection issue during the holiday, the implication from this data may not be strong for the near-term growth momentum. But I would say we should pay more attention to the price index of PMI, which will be less impacted by the holiday effect, and also could tell us more information about the inflation outlook of China. And actually, we have already seen some improvement in the PPI in the past couple of months. It will be interesting to see whether this momentum will continue.
Okay, interesting. Just to complete the picture in terms of what's in store for the rest of Asia, we have one central bank, BNM in Malaysia. We expect the policy rate to be kept unchanged at 275, but what we're watching closely is the tone of the policy statement. We think there could be a little bit of optimism in terms of the growth outlook, given the outturns in Q4, which was stronger than expected, or revised higher rather. And then some officials, including the governor himself, is saying that are saying that growth momentum could continue in 2026. Yeah, so a little bit more optimism there. And then finally, we have a bunch of CPI numbers coming out across a few countries, but I would say we won't read too much into them because some of these numbers are distorted by moving holiday effects, whether it's a Lunar New Year, as Jing mentioned, for China as well, but also the start of the Ramadan, and then some base effects. But I would say the picture is generally benign still. So a little bit of a pickup in Taiwan, but that's payback effects from the moving holidays. And then in Philippines and Korea, it picks up slightly to 2.1 from 2%. So exactly the same numbers for both countries. Indonesia, a little bit of an outlier. Inflation will be relatively high at 4.3 and above target, but this is because of base effects, and that should normalize at the next few months. And lastly, I would emphasize Thailand actually is interesting to watch because we think inflation is still going to be negative, and in fact more negative at minus 0.8 from minus 0.7 in January. So again, just showing still some weakness in demand side conditions. And I think that's one of the main reasons why Bank of Thailand this week surprised with another 25 basis points cut, citing downside risk to inflation. But our view from here, because they've signaled that they see the stance as sufficiently accommodative, we think their BOT's cutting cycle is done, and they will keep the policy rate unchanged at 1% for the rest of the year, unless we see renewed major shocks. Okay, I think we can leave it here. Jing, thanks again, and hope to have you again soon.
Yeah, talk to you next time. Thank you.
Now, for this special segment, we'll be speaking with Kitaoka-san, our chief equity strategist for Japan. The last time he was here in December when he discussed the year ahead outlook for equity markets in Japan. So given the strong performance of the Nikkei, especially since the landslide election victory of Prime Minister Takaichi's LDP in the lower house, I'm pretty sure everyone will be interested to hear his latest views. So hello, Kitaoka-san. Thanks again for joining today. Really appreciate it.
It's a great pleasure.
So just a few questions from me. First one, in a joint report that you published this week, you upgraded your targets for Japan's equity markets for this year. Can you give us the main rationale for that, please?
Yes, I recently updated Nikkei's target at the end of this year, around 60,000 yen. And at the end of next year, 63,000 yen. Upper region to reflect three reasons. The first, of course, Takaichi's victories, which is providing higher confidence for the greater nominal growth rate over nominal interest rate. So G greater R is basically supportive for Japanese equity market based on our backtesting, because the Takaichi's policy is inflationary and also taking care of the cost of debt. So in that sense, the probability of the higher nominal growth rate over, say, 10 years or cost of debt is likely to be greater. The second, to reflect the third quarter earnings result, October to December. So far, so good. The two drivers, the volume recovery and also the price hike, inflation, very supportive for earnings. Unfortunately, in the previous year, we have two major headwinds. One is tariff and second is stronger yen. But these negative factors are now disappearing. In that sense, this year we are higher confidence for the double-digit EPS growth in 2026 fiscal year. The thirdly, after Takaichi's victory, we are expecting money inflow into Japan equity from foreigners. Based on my marketing visit to Europe 2 weeks ago, and also in my recent discussion with global clients, and also even Japanese clients are also getting much more positive on the equity market because of the Takaichi's policy is very popular among Japanese equity investors.
Okay, great. Yeah, sounds very convincing, and really interested on your point about nominal GDP growth picking up as a result of some of the government's policies. Secondly, Kitaoka-san, any changes to your preferences of sectors that you see could outperform?
In the sense, I'm keeping the positive stance for the electric machinery, so tech and also general machinery like defense or robotics, because they are very structurally important to industry for Japan and for Japanese equity market. But recently, I dropped trading house and real estate from positive sector to neutral because of the such a taking profit. Valuations are now reasonable compared with the previously undervalued in our top-down assessment. And also from tactical perspective, I added the information and communication as tactically positive sectors because of the recent sell-off provides reasonable or a little bit undervalued situation. And also I continue the tactical positive stance on the autos and insurance, also because of the undervalued, and also there is support from the autos in regard to the higher confidence for the high growth rate in next year 26, and also as for insurance sectors, the potential for the increasing return to shareholders in our top-down assessment.
Okay, right. So it sounds like a few sectors still that could do well. And finally, Kitaoka-san, similar to my question to you in December, where do you see the risks around your baseline scenario, both downside and the upside?
Okay, first for downside, this is now gradually small after the election, but there is still risk of the setback for corporate governance reform and also setback for the reflationary momentum. But the recent election result is very encouraging because the opposition parties were proposing anti-corporate governance and also much more deflationary policy. So in that sense, at least in the near term, the risk of such a setback for the corporate governance reform momentum and also reflationary momentum is now lower. But still, there is some risk. We should pay attention to the Takaichi's popularity. Every month, we should check how public poll result. Currently, 60 to 70% okay, even 50% okay, but below 50, so below 40, a little bit cautious concerns from market perspective. And on the upside, now of course, the growth policy is a potential catalyst for further upside. We are waiting for a much more clear-cut numerical evidence for the growth strategy, including AI or robotics and semiconductor and so on. And related upside catalyst is sector-wide consolidation, much more reshuffling of the corporate sector or sector-wide. So far, there is no substantial consolidation so far. But if this is the case, the market will be so possibly reacting to the quick manner of the sector consolidation.
All right, fantastic. Yeah, sounds like a few things to watch, but relatively balanced risks. Thanks for your insights, Kitaoka-san, and hope to have you back soon.
Thank you.
Well, that's it for now. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast from your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out nomuraconnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connect at www.nomuraconnect.com.